Welcome to TradeTheMBI.com. This is John's Reports for the 20th of April, and we know it's springtime because my face has exploded with allergies, and the market has begun a little bit of softening off of its big run. Now, we still have this declining highs here on our Morganacci lines, which typically when we get over the 50% usually draws price back up to it. The only problem is that you can trade soft and sideways, and this can move down pretty quick and catch it. So it's not an indication that you're going to jump all the way to this level. It's just an indication that they're going to meet here at some point in the not too distant future. That said, we've had the rising gold here, which usually pulls price up as well, as long as it's following the direction of the shakeout. This is just a little bit of softness within a pretty broad run, and that's kind of what I talked about with this triangle squeeze setup. It breaks out and then it just kind of rolls over a little bit, and then usually you get either your next move, and you can extrapolate based on the size of the apex and all these wonderful technical analysis things that work sometimes. That's about the extent of it. What we do know is real is that we went from shakeout moving towards positive. We were just at negative, and then boom, we've rolled over completely on the shakeout. So still haven't gotten to what you would call breakout market conditions. So keep that in mind. It's an indication that you can be unafraid to short moves as well as be long either way, and it's proven to be the case even the other day. We'll look at the intraday chart. It was hilarious because it was pretty much a down day, and the short signals were very clear. But you had brief news that lo and behold, Trump is not being investigated, or whether he's being investigated or not, he's not a target of anything. Which I think that was sort of known by people who pay attention and read, but guess not for the market. The euro, still elevated, and this is going to become more problematic here as this understanding of oil prices and that really weigh on the, treasuries as far as that goes, because inflation in that is real in the U.S. and it's not so real in Europe, and it poses a little dichotomy. And so here we finally begin to see, what's expected. A realization of, rates could rise significantly, and if that's the case, then the discount to treasuries is going to be significant. Exactly. That's been an interesting trade to see it go that long, that extended, without a recognition of what's actually happening in the real world. Oil, again, this is outside that range, and this is going to be that inflation factor later on in the year, and there's no way around it. You add that to a tight labor market, and you still continue to see gains in employment, that squeeze is going to become significant in the later half of the year. And the Fed can see this, and they're suggesting that they're going to be raising. But as I've postulated, I think the Fed is intentionally going to be behind the curve on it, because actually that added inflation will, without raising rates, will help reduce the impact of the debt, because that's going to become a major factor, because every quarter point does a massive ramp up of the deficit. When you had zero rates, not a big deal to carry that because you were just paying a nominal fraction of it, but every quarter point really puts a dent in how much debt you're compiling. So from gold standpoint, that's going to be bullish for gold, no question about it. We've known that for a while, but it's been in a sideways zone for some particular time. All right, I got to shrink this day because this was a wild event. So I had posted back here the short setup that I have. This is with the new algorithm that I've been working paint bar wise, and the short was here up at the was the 20. Basically, the 27.15 was roughly right about the 76% line, and it was a clean short setup, we had moved to negative shakeout, which is basically what the program is following, combined with weakness from DOC readings. And pretty much it perpetuated that. We had a little brief rally, and then boom. Now, what you see with these white candles, these aren't MBIs. This is just part of the program identifying special bottom conditions. And really what it's looking for is it's looking for moves of the steel above 13.5 and suggesting that that is a continuation bearish move until the, let me just draw the little arrow. So it goes basically from here until the steel crosses below the cyan right there, and that is the end of the color. Now, within this configuration, we can identify two particular setups. Typically, number one, bearish move with continuing new lows that then shifts to a dip of the orange at the negative 13, where you have green crossing back above red. And that run usually lasts the duration of the orange until it crosses above the green, and then oftentimes what it'll do is it'll repeat that, so it does it again right here and completes it right there at the peak. So I did the first little teeny move and then captured in here right around the 23 and caught it until the top portion of it. But for the broader standpoint of it as it is now, it would generally left it short, which I was able to cover this bottom here and then add in at the 38% here, and then we rode this short all the way back down. And that didn't change, and then we had this beginning buildup, and then you had the freak news right here that Trump wasn't the target of anything, according to Rosenstein, and that just caused this big pop, but most of it was a bit short covering because it had been a long day down. And it's interesting about this, when you have this kind of a down day, normally you finish near or at the low. So this pop-up to me was a good indication that we're going to end up with another short opportunity, in which case we got that here at the later portion. And we're coming right back to those lows, which would have been expected. So all in all, fit within there. It's a very exciting program because I think it really starts to identify the ranges of the market, and then it's a matter of separating these unique buy configuration setups that come in that are in anomalous portions where we get extreme behaviors from the DOC readings. And that's usually where you get, because when you get muck, and this is a perfect example of it, there's just nothing going on here, and what is the market doing? Nothing. You know, the market is based on when there's algorithm activity where they sense an edge one way or another, and they begin to take advantage of it through size and volume. And when they go too far and the other side sees that they've got an opportunity to do the exact opposite. And that's why they call it mean reversion markets, but really it's just one side attacking the other side, and then somewhere in between them there's supposed to be price discovery. But I think we all know that that is subjective at best, because, okay, what if a good portion of the algorithm traders believe in a certain PE and others believe in a different one? You know, this is that market multiple variation that, and particularly in an inflationary market, has a general upside bias to the market. So the gloom and doomers, you got to be careful, because even in the gloom and doom, if you're expecting annualized inflation at a X value, you've got to discount that into the market price, which is going to increase the market price, even though that really will represent a degradation in overall value. You're pre-pricing it in. So I know that gets complicated, but you know, it's you have to be aware of it. Otherwise, you might think that, oh, you know, interest rates are rising, therefore the market should automatically fall. No, it's not built into that way. What you are going to see is that they're not going to take a hit. This is no different than we see it in the oil trade, where it comes to the euro. Because oftentimes you'll get oil rising unrelated to anything other than the exchange rate between the dollar and the euro, simply because most of the OPEC countries purchase things from the EU and want euros, and therefore they don't want to see their buying power diminished. And that oftentimes, prior to the whole shale explosion, had really been a strong impact of the euro-dollar relationship. So it all becomes macro and then micro at the same time. So it's a nice relationship. And when you begin to see how those correlations work, it really helps to unfold. And then you can see disparities where there's something wrong going on. And that's when and we typically will see it in our algo behavior where, like with the euro, you get manipulation from central banks and that. And we had that for quite a few years, and we talked about it, and that has changed. And it's in this change that people are getting used to. This was the whole collapse of the low volatility trade and the stupidity of shorting, a VIX under 10, or in some cases under 7. It's odd behavior, but this is what there's no stopping stupidity. There's that's not something that's prevented anywhere. And then you hear all the stories about retail investors pulling out, and yet the market has maintained its highs. So, these are anecdotal things that you hear after the fact. What we see in the direct market was, hey, we've had a big run. You're getting a little bit of fill back into that. We're at the end period of a month. There's no new buyers available from a fund standpoint, and that's not going to happen for another 10 12 days. So that puts strain if there are people that want to distribute shares, take profits. Plus you have earnings starting to break and go through things, and that's going to definitely have an impact just from a psychology standpoint. Not to mention on individual stocks, which will weigh or buoy the market. It depends on who they are and what they are, because if you're Amazon and you're already trading at ridiculous multiples, you should continue to rise indefinitely. That was a joke. Anyway, all looking good here. Nice little dip here as we fill back in. It was interesting because even on that pop, you could see we had positive extremes starting literally immediately. Well, these dark blue ones, they represent the same thing only when the extreme is positive. It goes ahead and colors them blue, but that's not going to be accurate, because the reality is, what's interesting about this setup is this should actually will become a red candle, and the signal would be to short the close at 26.98. Isn't that ironic? Because that ultimately becomes the premier, because immediately you drop down the next bar dropped down to 93, 94 for the close. So interesting on the pop that it wants to get out at the high, which what more do you want than that? And then in declining shakeout. So that will also recognize it, and there'll be an adjustment, because basically instead of seeing any green on here, this is all going to appear red going forward. And then what you'll see is more green coming to the south side as some of these other conditions are met and filled in. And that's the work that goes in maintaining it with the zones, because that's the way I've converted it to make it easier for everyone to identify it. You'll have falling 23%, which is weak market, and then when it goes from higher to flat, you'll have a what we would call positive for rising, but then positive neutral when it's come from up and flat. And that was where things were going through in there. And then the shakeout here has completely fallen apart into a nice negative. So, as always, I will continue to post things on the Skype chat, but continue to be programming. So, might not see a ton of posts from me, but on occasion I'll pop in as adjustments are made. Trade well. We'll talk again for Monday.